Hey everybody, welcome to Strategy Now at MarketStream.live. My name is Joseph Cusick with the Cusick Group. Securities offered by MoneyBlock. And no, I do not wear makeup when I do this stuff. There is no production team. It's just me, the markets, and you guys out there. So what I wanted to do in Strategy right now is just take a brief overview of diversification. I think that it's worth taking some time to talk about how when you construct a portfolio, and everyone talks about having diversified assets, right? So you have exposure to tech, and you have exposure to emerging markets and foreign markets and commodity markets. And really what I want to clarify is that as you think you're diversified, you may not be, especially if you start to see not only that the markets start to move here in the United States, like in the S&Ps, the Dow Jones, and the NASDAQ in one direction or the other, and those markets are very highly correlated, by the way, you might have exposure in, let's say, the emerging markets, and our markets go down. Well, emerging markets, you think, well, I'm going to get padded there. It won't go down as much, or it may even go up. Not necessarily true. And as markets get more volatile, the correlation to some of these assets that you think are diversifying your portfolio actually become closer to where your core risk is. So, for example, I have the SPY. That's the S&P 500 ETF. That's a common core holding of a lot of traders and investors like yourselves out there. Now, let's say that I bought some the all world market. Okay, that's the EFA. That's the ETF that tracks Europe, Far East, and Australia. So there are some mature markets in there. And you would think, well, I'm diversified. Well, that green line, it really actually looks like, as it tracks these candles from the S&P 500 of the spiders, these are highly correlated. As a matter of fact, you're looking at it that basically over 2016 going into 2017, we've seen that these markets, as the S&Ps go up, so did the all world index go up. As the S&Ps went down, so did the all-world index. As the S&Ps went up, so did the all-world index. Now, are they correlated one-to-one? No. But as you can see, when volatility was a little bit higher, like we had back in maybe February, as a matter of fact, if I scale back even more, I can even go back and look, let's say in October and December when we had a little volatility spike, you can see that they're very highly correlated when volatility starts to spike up in the marketplace. So something like, oh, well, if I have EFA in my portfolio, I'm diversified. Well, actually, not really. These are actually pretty highly correlated. Same goes for emerging markets. If I actually take a look at the emerging markets, you can see the same correlation component, right? Not one for one, but it's pretty close. And as markets get more volatile, these correlations start to actually get closer with what would be considered an asset class or a segment of the marketplace that's supposed to have some diversification in case the S&Ps in this case go up or down. You're going to have a little bit of diversification. So how do you really diversify? That's where you have to start looking at asset classes like currencies. Let's take a look at FXE. Okay, FXE is a currency. Actually, if you just type in the symbol here, this is a currency ETF. It's for the euro. Okay, and as a matter of fact, if I disable EFA and enable FXY, so you can see here, when the markets were going up in the S&Ps, the euro was going down in the currency marketplaces. So if I was long the market and long euro, well, the euro's not working for me. It's actually working against us, but it's supposed to be acting as a hedge anyways against the currency. So that means probably strong dollar, strong market. And you can see that when the market started to get weak, you saw that the euro started to go up. And again, we're looking for diversification, not necessarily hedge, but diversification. What is diversification? It means that when my core holding, the S&Ps, which might be anywhere from 20 to 30, 40% of my portfolio, when that starts to go down, I want to have an asset class that's going to be moving in the opposite direction. That's not acting as a pure hedge, like buying puts, for example, in the S&Ps or the spiders, but it's another asset class that's going to diversify my portfolio, so to mute maybe the downturn in a larger portion, not completely. And you can see that the euro, as the market was going down, the euro currency went up. Okay, so again, I'm just trying to point out that where you thought you were diversified, here's the yen. Again, we were talking about this in the overnight action report, where we see a strong yen and we see a weak dollar, so you see that currency pair, but you also then would look at the U.S. markets and you'd say, well, when the U.S. markets were going down, the yen was going up. That is a diversified asset class to your core portfolio. And so that's really what I'm trying to highlight here with these different asset classes. You can say the same thing about gold. I think you can see this, but the gold line right here, market goes down, gold line goes up. Now the gold line is continuing to go up and the market is actually static. Okay, so like I said, it's not a complete diversification. The market came down, but gold was coming down. And there could be other ramifications that are going on, other things that where they're not exactly non-correlated asset classes, and they may not be complete diversification. There could be other fundamental reasons why both the market and gold's going down. But again, you can see that that's truly when the market is going down. This is a diversified asset class. It's moving in the opposite direction quite a bit of the time. And then the last one that I want to take a look at is bonds, right? You see that when the market goes up, here's the other thing. When the market goes up, bonds were going up, bond prices. When the market goes down, bond prices are going down. You're seeing that the bonds and TLT are highly correlated to the market, right, at this juncture. Now, when implied volatility starts to rear its head again, you could see that this actual relationship shifts. We saw that back in October and November of last year, where things got so uncertain. Volatility rose, and you saw bonds were staying up in price while the market was going down. But once the market realized a general directional bias, in other words, in this case, you saw that the market started to go up going into December and January, February, and then consolidating, you saw that bonds came down and now have been sitting on their lows. They started to rear their heads up as there has been growing uncertainty or at least momentum to the upside. And so we'll see if this actually consolidates a little bit more, and you see that bonds might hold up, even though we do have other forces working in the markets. But I just wanted to point out how you truly can look at different asset classes, different sectors and segments like emerging markets, commodities, and truly where are you getting those diversification capabilities, and what's going to be the best diversification tool when you're starting to look at establishing and building your investment portfolios. All right, folks, that's it right now for Strategy Now. Thank you for being here. We're going to be back on at 3:30 Eastern Time. We're going to be doing Tech Talk. So join us here at MarketStream.live.